Nitin Raheja, last week it appeared that banks had stabilized. It appeared that the entire bearish view which the street had on banks because of moratorium, because of economy, because of NPA concerns, that got diluted. But looks like it's back to square one. I mean, after 5-7 days of good, good gains, banks are getting bashed up again.
Nikunj, I'm afraid that is going to be some sort of trend that we will continue to see in the market for some time. Look, at one level, whenever the market moves up a lot, how people start looking for sectors where they feel there is yet value. And but don't forget that the entire banking and financial sector yet has a long way to go. The after effects of this moratorium and the impact that we're going to see on the balance sheets is yet going to play itself out. And the fact is that the economy is also at a far slower growth rate, which is not, and there is no credit growth that is happening. So I think banks will see this intermittent nervousness whenever there is some sort of broader nervousness that creeps into the market. They will be the favorite places which will investors will look to sell out of.
What is the nervousness today? I mean, why are banks getting hammered today? Is it because of what we've picked up on the border, or this is just profit booking? I mean, there's nothing in the air which explains nervousness.
So, Nikunj, look, with the kind of rise that we've had, we will see these kind of profit bookings. But my own view also is that probably one of the factors that is playing itself out is that, come tomorrow, you're going to have these new margin norms that are coming into play for brokers, where clients will have to, pledge shares, or they will have to put up margin upfront. Now, if you sort of match that in with the fact that, I was just looking at some NSE data, the share of retail or the so-called non-corporates, non-FIIs, non-DIs has actually gone up from 47% in the trading volumes to 54%, which is in line with the fact that there's been so much of retail interest that has entered the market in the last 5 months in the current year. Now, there is a possibility that this new norms could be causing a little bit of sell-off or pressure, because now you have to actually cough up margins up front, and there could be readjustments taking place. That could possibly be one of the reasons also that could be ascribed to the sell-off today.
Godrej Properties, Adani Ports, Marico, very different kind of names which are there. So Nitin, just one more follow-up question. Let's spend a minute understanding this margin issue. Historically, when these margin changes have happened, they've in a sense punctured the mid-cap momentum and small-cap rallies. So are we in that kind of a phase where this margin, the margin requirements of the new margin laws are going to change things, and they could really push back mid and small-cap stocks decisively?
So I do see some sort of a correction happening. Now, to what extent is that correction going to be there? It's very difficult to call, Nikunj, because I'm just trying to tie in two ends, that the fact that retail participation has gone up, B, mid caps have gone up. And generally speaking, we find that the retail participation happens a lot in the mid and the smaller cap name. And now with this margin compression, or it might take some time for investors to start readjusting the way they work, and and even brokerages are trying, to level best. They've been sending out mailers to people to create a more seamless mechanism where a client can pledge his shares and then unpledge them, and so on and so forth. So, but against that, you also don't forget that I don't really expect a sizable correction to take place, for the simple reason that you are sitting on a Fed put on the markets, where at lower levels you are going to find interest coming in from the FIIs and the DIIs. So I don't see the markets correcting a lot, but they could have these intermittent corrections, and some of them could mean that the cuts could be like what we are seeing today in some of the pharma or the chemical names, because that's where people have really made a lot of money, and that's where they are seeing maximum pressure happening.
All right. Nitin, across the broader markets as well. So, at least we had breadth really play out over the last couple of weeks. Today, we're actually starting to see a sell-off really deepening there as well. Like Nikunj was just asking, what's causing this amount of nervousness? It can't just be the border tensions or consolidation. Is it really going a little deeper than that? We're seeing even the pockets that have been running up quite consistently, whether it be a pharma, IT, some of the other broader market trends, all of them actually seeing a rub-off effect today.
Whether it's the border tension, I'm not so sure in terms of what kind of impact the border tension would really have. According to me, this is more of a technical sell-off related to the new margin norms coming into play, possibly. Also, don't forget, because the sell-off is happening in spaces and sectors like the mid-caps, which have seen very, very deep cuts. Now, those are traditional areas where the retail participation has been the highest. Also, some of these mid-caps have seen some tremendous run-ups. So if people are also trying to sell somewhere to raise some margin, they're really looking at where they're sitting on big profits. And hence you're seeing the big difference between the Nifty and the mid-cap index.
Welcome back. We're also watching out for those GDP numbers today, the Q1 figures. Let's go across to Poonam for the expectations this time around. Poonam?
Well, the Q1 GDP is likely to see a sharp contraction, anywhere around 19 odd percent. In fact, GVA is seen contracting 20 odd percent, and this is on account of the COVID-19 lockdown. To know that the Indian economy was already struggling even before the COVID times, and with the lockdown, this is going to be the lowest point of the Indian economy. In fact, the GDP is seen contracting anywhere between 15 odd percent to 25 odd percent according to various economists, and the silver lining would be the agriculture as well as the government spending. Both agri and government spending should be lending some support, but overall manufacturing and services sector are going to see a sharp contraction of anywhere around 35 to 50 odd percent. In fact, if you look at the good rabi crop, that is going to support the agri, forestry and the fishing segment, which is seen growing anywhere between 4 to 5 odd percent versus a 3% on a YOY basis. Manufacturing, construction would see sharp contraction. Trade, hotels, transport, communication, these segments are also going to see a sharp contraction. High frequency indicators are suggesting a pickup in the activity in the month of May and June. However, that activity is seen flattening in the month of July. RBI has already stated that FY21 will see a contraction, and economists do hope for a 25 to 50 bips additional rate cut coming into the rest of the year. However, a pause in the near term, but as of now, a sharp contraction in Q1 GDP.
So look, it's been a rather tumultuous quarter. We've seen a once-in-a-century pandemic. We've seen an extremely stringent national lockdown. And then we've also seen the pent-up demand once the lockdown was eased. All of this in one quarter. So it's going to be very interesting and very exciting to see what this one number, GDP growth, will encapsulate and where it will come. Now, in terms of growth forecast, we think the CSO will announce a number which is close to 17.5% contraction. But eventually, a couple of quarters or perhaps a year and a half down the line, we think this number will be downgraded to closer to 25% contraction. And I'll tell you exactly what we think is going to happen. The way we collect data, we don't have a real-time estimate on the informal sector. For real-time data, we use formal sector to proxy for informal. This is fine during normal periods, but this is not normal. This is a time when the informal sector has done much worse than the formal. And therefore, if you use that practice, you actually tend to overestimate growth. So we think it's going to be an overestimated growth. It's going to be somewhere close to 17.5% contraction. But a couple of quarters down the line, when the informal sector survey is available, this number will be revised down to 25% contraction.
All right, watching out for those numbers. It's not entirely unexpected this time around to foresee that there is going to be a contraction. But Nitin, I guess it's about how deep those numbers are going to eventually be and what kind of mood they're going to set going forward as well. How closely are you going to be watching out for those numbers today?
So most definitely, I think there will be numbers that I think everybody in the markets is going to be looking at. But I think broadly, we also are pretty much aware, and I think the markets are pretty much aware in terms of what kind of number would be the broad ballpark as such. So in my view, I think, but more importantly, the markets have sort of, I would say, largely factored that in. If the number is bigger than what is within this expected range, surely the market would be, a little disappointed. But I think broadly, I think the market has understood and factored in, and is really looking at cues from here on. And I think from that perspective, also, my own view is that the cues from here on are not going to be very, very. While there are pockets of the economy which are talking of running at full capacity almost now, but there is this huge informal sector, as she rightly pointed out, which does not get very well captured in the immediate numbers, and only later on, once the data comes in, do those numbers come in. So I think that informal part of the market is, I think, the economy is yet in trouble. We can see that even from a perspective that if you look at all the so-called work from home, it's really encapsulated in the organized part of the economy, in the larger corporates and the top managements who are yet functioning pretty well and more efficiently in some cases. But where you need physical presence on the ground, which is the whole informal sector, those segments are struggling, and I think those numbers will take time, as the data has suggested. So I think it would be wrong to extrapolate when we talk to corporates and they give us one end of this thing. I think the lower end of the economy is in deep trouble.
Okay, I want to go back to pharma. It is in a bull market. If it's in a bull market, why have we seen such sharp cuts? Jay, in a week's time, in a month's time, how will we remember 31st of August? For someone who bought pharma stocks, they felt happy, or someone who realized that pharma has taken a turn and it's time to get out? Will the buyers be happy, or will the sellers be happy?
Well, looking from a long-term point of view, I agree with you that the overall trend has really shifted from down to up. I mean, we have seen that almost 6 years of downtrend in pharma index right from 2014 until the start of 2020. I mean, that clear trend has been reversed now. I mean, most of the stocks have in fact double or more than that. And on the monthly, quarterly charts, the stocks and the index has really reversed. So from that point of view, I would say that the bulls, or those people who are buying at this point of time, would be really happy in the long term. For the short to medium term, I would say that stocks, specifically those stocks which were really quite overbought and those are reversing, wherein we are seeing that kind of profit booking coming. I think out there the sellers would be happy in the short to medium term, because Nikunj, we have seen that negative divergence coming in the pharma index, when the index was continuously going up and the momentum was not supporting the same, and we just saw that few of the pharma names were actually helping the index move higher. I'm talking about the Nifty Pharma index. And now what's happening is now all the stocks are in fact have reversed and they're falling down. So I think in the short term the bears will have an upper hand, but in the medium to long term, in fact, I would say that the bulls are definitely going to have the upper hand and they will be happy. So selectively, if someone is buying the pharma names right now, which are relatively cheaper right now, are definitely going to be happy.
Nitin, as we roll over from the first half to as we roll over from Q2 to Q3, do you think somewhere this market for this year pretty much is near its peak, plus minus 500-600 points on the Nifty? Do you think somewhere 12,000 could act as a higher watermark for the Nifty and we are not in for a strong acceleration till December?
Pretty much so, Nikunj. I think if I look at it purely from a fundamental perspective, I think the market is probably close to its peak. Like you rightly said, 500-600 points here and there. Given the fact that most corporates are now only talking about 22, closing stages of 22 coming back to where they were from a run rate perspective. So given all of that, surely, but within the market, there will be pockets which will probably be much higher from where they were. And I think that's probably. But with liquidity being so loose, who knows? That could upset your calculations. But yes, from a pure fundamental perspective, I think we are pretty much there, and we would probably want to trade in a range for some time.
To understand that lockdown has been restricted in a lot of pockets, but nothing has come so far from multiplexes. PVR is down another 9%. I was just reading that international flights will not start for another month at least. I mean, it could be extended more than that, but at least. So no international business comes Indigo's way or SpiceJet's way. That's again is going to have a very largish kind of an casualty. It's not a casualty today, but yeah, that's something which is going to be having a huge important impact on them. Nitin, what is your view on ITC? I can argue both ways. The bearish argument is it's ESG, it's cigarette, it's a sin business, and it will get punished. The bullish view is that cheap, dividend yield, FMCG business is sizable, and it's a cash generating machine.
So Nikunj, look, my view is that ITC has been run all these years like a like a closed club. It generates huge amounts of cash. It sits on huge amounts of cash. It has invested in businesses which have not given it returns anywhere close to what the cigarette business is. Its FMCG business is large from a perspective, but look at the kind of money that it makes on it. The hotel business again is capital intensive, doesn't give anywhere close to the ROA. So you have a business where you have a large cash generating business on which your return on equity and return on capital can be huge, but you don't distribute that cash. That cash is deployed in businesses which have so far not given you even remotely close to even earning the cost of capital on that business. And then you're sitting on huge amounts of cash. So I think it's just been a very, very shareholder unfriendly company. And precisely for those reasons, it doesn't get valued. And of course, cigarettes is again then the favorite whipping boy, or the every time the government wants to garner some revenues, it goes and raises taxes on cigarettes as such. So it kind of continues to disappoint. As from a valuation perspective, it is attractive. It's got a business with a moat, but I think the management just does not do enough to unlock value for shareholders.
Just looking at the charts of Tata Motors, irrespective of how the rest of the market is panning out today, this has really been the poster boy, holding up solid another 2% or so. Though at the high point of the day, it was much higher. It's seen a bit of a cool off, but still showing a fair amount of resilience. Nitin, irrespective of the naysayers and all the ones who were doubting as to how N. Chandra is going to reduce debt in Tata Motors to near zero in the next 3 years, the stock price has been doing a completely different story. From that day, it's held out massively. Do you think there is merit in at least giving the benefit of the doubt that N. Chandra will manage to pull it off?
Like to give him the benefit of the doubt because he is an efficient manager and he has been doing the right things in terms of as far as the group is concerned, with a lot less fanfare than his predecessors, and he's a more operational, hands-on chairman. And surely, I think there is enough of areas within this group where for it to get more efficient as such, and more so for Tata Motors, which is an extremely strong engineering-based company, but it has just sort of expended capital in businesses which have not given. And it's to be honest, any of the Indian companies who have gone and become international and have acquired businesses overseas, if you see their valuations over a period of time, they've only trended downwards. They've trended more and more and more towards international business valuations, which are far lower the P's. Because out here, businesses in India who are more India focused actually tend to trade at a higher PE because the growth rates in India have historically been, far stronger. While internationally, what happens is that you have one geography doing well, one not doing well. So growth rates have tend to sort of be far more subdued. So I think Tata Motors really suffers from that, and so do a lot of other Tata businesses which are international, and they trade at substantial discounts. And doing some of these steps probably to unlock some of these parameters is the right way for them to go.